Finance Minister Nirmala Sitharaman recently chaired a meeting with the heads of public sector lenders in order to ask them to boost deposit growth. As banking deposit growth slows, while credit growth is on the up and up, there's trouble brewing, no doubt. Over the past few months, deposit growth has lagged credit growth by around 3 to 4 percentage points. According to the latest RBI data, as of July 26th, bank loans surged over 13.7%. On the other hand, deposits only grew by 10.6% year-on-year. So what is the issue between slowing deposit growth and rising credit growth? Banks actually need your deposits in order to lend money to other clients. If deposit growth falls, but credit continues to be on the rise, there will definitely be an issue with liquidity for these banks. That's why, in order to avoid a liquidity crunch, the finance minister has sounded the alarm. In the blame game of financial crises, guess who's the fall guy this time around? Of course, it's equities. But as usual, equities is not the real fall guy, and the real villain remains unidentified. Let's lay out the facts together. Households are definitely moving their money from traditional banking instruments such as a savings account or a fixed deposit into the equity markets, either directly or via mutual funds. Households are now willing to take on more risk in order to gain better returns. Are equities really the villain when it comes to bank deposit growth falling? The RBI governor might think so. He pointed to the markets in a recent interview, saying that young Indians are increasingly attracted to equities. But again, are savings really being swapped for equity instruments and investments? Let's dive into the data. In FY24, the ratio of mutual funds AUM to GDP hit a record 18.1%. Meanwhile, the bank deposit to GDP ratio actually fell from highs to 69% compared to FY21 levels. In the financial year 22, households showed a clear trend, a definite preference for mutual funds over traditional deposits. The shares of deposits in the gross financial savings of a household dropped from its long-term average. On the flip side, the share of mutual funds in the gross household financial savings jumped from its long-term average of about 2% to 6%, which is a whopping rise of 4 percentage points. Therefore, even experts can't deny that there is some definite rejigging in people's portfolios. However, the quantum of the rise in mutual funds cannot be compared to the quantum of the fall in banking deposits. The markets are buzzing with a growing risk appetite as equities rally and savings become more financialized. But before we get into if equities are genuinely impacting bank deposits, let's take a look at how money moves from your bank account into the equity markets. When you buy stocks, your brokerage pulls out funds from your bank account. Simple, right? But here's where it gets interesting. After you buy shares, the money just doesn't vanish into thin air. It ends up in a seller's account. When the seller of a share decides to offload his holdings, once your brokerage charges are deducted, the money is actually deposited into his bank account. Even when mutual funds buy a share, the seller of a share, be it a person or a company, gets the proceeds into their bank account. So what happens is that while the funds might shift from this account to that, the overall deposit levels shouldn't drop. They remain the same, as money is just moving around. To take it one step further, if the company you invested in chooses to spend that money either on buying equipment or even paying workers' salaries, accordingly that money will be debited from the company's account and put into the account of a beneficiary. That is why some experts say that deposits never do really go down, they're just shifted around and the ownership of the deposit might change. When we take a look at the long-term trends, it further reinforces the fact that mutual funds are really not the villain. Sure, mutual funds are growing faster than bank deposits, recording a massive CAGR of 20.5% over the past decade, compared to about 10.3% for deposits. But in the 2000s, strong equity and insurance flows did not hurt bank deposits' growth. Instead, they both grew in tandem. However, from 2010 to 2014, as equity flows slowed down, so did deposit growth. Only in the last decade or so, the trends have diverged. Bank of Baroda recently conducted a statistical exercise to show whether there is some degree of crowding out between mutual funds and bank deposits or not. The econometric analysis stated that there was no direct correlation between the two. So then what could really be causing deposit growth to slow down? Households require more currency or cash in hands for various reasons, especially during times of high inflation. Second, the government chooses sometimes to keep higher deposits and higher balances with the RBI, which means that they are slow to spend all their tax revenue. Third, if there are foreign capital outflows from the economy, then it would also weigh on deposits. So while the equity boom might be raising eyebrows, it's not necessarily draining bank deposits. The current trends could be more coincidental than causal. And that's why equities are not the real villain in this problem.